Hi all, welcome back to Finalit YouTube channel. Today we are going to discuss about initial public offering, IPO. The topics you will learn today: what is IPO, why do companies go public, how do companies go public, and few IPO terms. What is IPO? The primary market where a company gets registered to issue a certain amount of shares and raise money. This is also called getting listed in a stock exchange. A company enters primary markets to raise capital. If the company is selling shares for the first time, it is called an initial public offering, IPO. The company thus becomes public. When a company files for an IPO, they have to offer their shares to the general public. The general public will subscribe to the shares by paying a certain price. Now, because the company is offering the shares for the first time to the public, it is called the initial public offering, IPO. Why do companies go public? When a company decides to file for an IPO, invariably the main reason is to raise funds to fuel their capital expenditure requirement. The promoter has advantages by taking his company public. 1. He is raising funds to meet his capital expenditure requirement. 2. He is avoiding the need to raise debt, which means he doesn't have to pay finance charges, which translates to better profitability. 3. Whenever you buy a share of a company, you are in essence taking the same amount of risk as the promoter is taking. Needless to say, the promotion of the risk and its impact will depend on the quantity of shares you hold. When you buy shares, you also buy risk. So, when the company goes public, the promoter is actually spreading his risk amongst a large group of people. 4. Provide an exit for early investors. Once the company goes public, the shares of the company start trading publicly. Any existing shareholder of the company could be promoters, angel investors, venture capitalists, and private equity investors. They can use this opportunity to sell their shares in the open market. By selling their shares, they get an exit on their initial investment in the company. They can also choose to sell their shares in smaller portions. 5. Reward employees. Employees working of the company would have shares allotted to them as an incentive. This sort of arrangement between the employee and the company is called the employee stock option. The shares are allotted at a discount to the employees. Once the company goes public, the employees stand a chance to see capital appreciation in the shares. Few examples where the employee benefited from ESOP would be Google, Infosys, Twitter, and Facebook, etc. 6. Improve visibility. Going public definitely increases visibility as the company has a status of being publicly held and traded. There is a greater chance of people's interest in the company, consequently creating a positive impact on its growth. How do companies go public? Each and every step involved in the IPO sequence has to happen under the Securities Exchange Board of India or SEBI guidelines. Step 1. Appoint a merchant banker. Merchant bankers are also called book running lead managers, BRLM, or lead managers, just LM. The job of merchant banker is to assist the company with various aspects of the IPO process, including conduct a due diligence on the company filing for an IPO, ensure their legal compliance, and also issue a due diligence certificate. Should work closely with the company and prepare their listing documents, including draft red herring prospectus or DRHP. Underwrite shares. By underwriting shares, merchant bankers essentially agree to buy all or part of the IPO shares and resell the same to public. Help company arrive at the price band for the IPO. A price band is the lower and upper limit of the share price within which the company will go public. In case of a large public issue, the company can appoint more than one merchant banker. Step 2. Apply to SEBI with a registration statement. The registration statement contains details on what the company does, why the company plans to go public, and the financial health of the company. Step 3. Getting a note from SEBI. Once SEBI receives the registration statement, SEBI takes a call on whether to issue a go-ahead or a no-go to the IPO. Step 4. Draft red herring prospectus or DRHP. If the company gets the initial SEBI note, then the company needs to prepare the DRHP. A DRHP is a document that gets circulated to the public. Along with a lot of information, DRHP should contain the following details. 1. The estimated size of the PO. 2. The estimated number of shares being offered to the public. C. Why the company wants to go public and how does the company plan to utilize the funds along with the timeline projection of fund utilization. D. Business description including the revenue model, expenditure details. E. Complete financial statements. F. Management discussion and analysis. How the company perceives the future business operations to emerge. G. Risks involved in the business. H. Management details and their background. Step 5. Market the IPO. This would involve TV and print advertisements in order to build awareness about the company and its IPO offering. This process is also called the IPO roadshow. Step 6. Fix the price band. Decide the price band between which the company would like to go public. Of course, this can't be way off the general perception. If it is, then the public will not subscribe for the IPO. Step 7. Book building. Once the roadshow is done and price band fixed, the company now has to officially open the window during which the public can subscribe for shares. For example, if the price band is between 100 and 120 rupees, then the public can actually choose a price they think is fair enough for the IPO issue. The process of collecting all those price points along with the respective quantities is called book building. Book building is perceived as an effective price discovery method. Step 8. Brochure. After the book building window is closed, generally open for few days, then the price point at which the issue gets listed is decided. This price point is usually that price at which maximum bids have been received. Step 9. Listing day. This is the day when the company actually gets listed on the stock exchange. The listing price is the price discovered through the book building process. The moment the stock gets listed and debates on the stock exchange, the stock starts to trade publicly. This is called the secondary market. Once the stock transitions from primary market to secondary market, the stock gets traded daily on stock exchange. People start buying and selling the stock regularly. Few IPO terms. Under subscription. Let's say the company wants to offer 100,000 shares to the public. During the book building process, it is discovered that only 90,000 bids were received. Then the issue is said to be undersubscribed. This is not a great situation to be in, as it indicates negative public sentiment. Oversubscription. If there are 200,000 bids for 100,000 shares, then the issue is said to be oversubscribed. Green shoe option. Part of the underwriting agreement which allows the issuer to authorize additional shares, typically 15%, to be distributed in the event of oversubscription. This is also called the over allotment option. Fixed price IPO. Sometimes the companies fix the price of the IPO and do not opt for a price band. Such issues are called fixed price IPO. Price band cut-off price. Price band is price range between which the stock gets listed. For example, if the price band is between 100 and 130 rupees, then the issue can list within the range. Let's say it gets listed at 125, then 125 is called the cutoff price. Thank you for watching.